Were you surprised to see that big comeback in the final hour of trade, Bob? Does it mean anything?
A bit so. Obviously, we saw it last Friday as well, and I think the intriguing part, Mike's already pointed this out, we got nowhere near the intraday lows of last Friday. We know bottoming of a market is a process. It is not an event. We'll probably have some more of this, but yeah, the magnitude of the ride in the last hour had to be impressive to everybody.
So before that, Bob, were you getting closer to wanting to buy stocks, and has that rally, which was worth a couple of percent, has that changed your mind on things or not?
So a couple percent doesn't do it for me. Look, we're in a period of time where there's far more we don't know than we do know. So I think you have to pay attention to the technicals and be a little more reactive. So this week on the big down days, I'm trying to intelligently do some adding. And on the big up days, try to intelligently let a little bit go. Transform the portfolio that way, reacting to the prices that are given us, because the mood swings are far bigger than the real world, which we don't know. I got emails from strategists on Monday, 3 of them, cutting my estimate from this to that. And I wrote back, based on what? Question mark. And what I kind of got back was, I don't know. I'm not criticizing them. Their firms are forcing them to say something. We don't know what to say yet. It's way too soon.
Bob, tell us some of the stocks or sectors that you have bought this week on some of those down days that you referred to.
So I want to own healthcare. Healthcare was a horrible performer last year, politics, et cetera. So whether it's a Gilead or a Cigna, those kinds of names. I also want to own some cyclicals. Target in the retail space, Best Buy on weakness. I want to buy those names. Their earnings have been pretty good. And yeah, we can say their earnings are going to be horrible going forward because nobody's going to go out and buy anything. But they're good companies that are transforming their business in the wake of the Amazon scare 3 years ago that they're going to kill all the retailers.
What are you selling?
Trimming defensive stocks. I wish I had more of them going into this, but what I have, I'm trimming. Utilities, REIT, sensitive to interest rates, believing that we're not going to stay down this low. Trimming some of the staples names. Great companies, but pretty expensive prices.
So what we didn't hear you say you're buying there, Bob, are the energy stocks, which have been absolutely slammed, the worst performing sector today and again this week. Why are you not buying those?
Yeah, so I'll buy some cyclicals. I'm not ready for the deep cyclicals. If you can convince me global GDP is going to be, 3.5 or more, then I can get excited about the price of oil. Then I have to buy energy, but I just can't see it. To get excited, I need some capacity to be taken out. Some more bankruptcies, maybe some M&A activity, and that's not real soon, I don't think.
And what about the banks? Similar kind of bracket in terms of they've been hit very hard over the last couple of weeks.
Yeah, I'm a better buyer than seller of the banks. I'm of the view that we're not going to have a big recession, that interest rates, to repeat, are not going to stay at, 70 basis points for a 10-year. Banks have done a good job at learning how to make money in a low interest rate world. They have strong balance sheets. So at these prices, I'm a better buyer.
How has the move, the Treasury move, even if you don't expect it to last, has been absolutely extraordinary. How has that move to 0.7 on the 10-year changed the way you look at stocks or sectors or try to reach for yield or anything you do?
Yeah, so without trying to sound too academic, my view is, as everybody would agree, when interest rates fall, PE ratios go up to a point. And I think we've passed that point, and I think lower yields from here are negative for stocks and for PE ratios. In fact, if you look at the intraday moves this week, you saw a lot. As the yield went down, stocks went down, not up, and vice versa. So the bond market's telling us, be careful, we got some issues here.
Yeah, Bob, obviously, to your point there, the standard ways of trying to settle on a fair valuation for equities, if you base it off the Treasury yield, we've been saying, stock market should trade at over 100 times earnings right now, right? So clearly not the case. But do you think the market at this point in aggregate has built in any kind of valuation cushion to the likely outcomes right now? We're down 14% off of a relatively stretched valuation in the first place.
Yeah, I think you pointed out that well. We came into this year overbought, and we could argue overvalued. Fundamentals improving, but mixed. And part of this decline is just erasing some of that FOMO, TINA euphoria that crept into the market. So I agree with you. Valuations are still not cheap. There's no question about it. Now, low interest rates, low inflation, PE should be higher. But we need to get some visibility on how much are earnings going to be hit to really have any clue what kind of PE to put on those earnings.